short-term investments. Treasury bonds, they are long-term investments. If you look at long-term investments, the interest rate is high. If you look at short-term investments, the interest rate is low. Now, let me come to the annualized yield and the daily yield.
The daily yields, yeah. You
realize if you look at that, the annualized yield is a little bit high. True or false?
Yes, it is.
The daily yield is a little bit low.
Just an example for one of them, it's 11.02% for the daily yield, and the annual rate is 11.59%.
59%.
Yeah.
So this is how they calculate. An investor is going to estimate that this person wants to invest. When you take the annual yield, the investor is going to give you the two rates for you to compare. The reason why they are going to give you and they are not going to be a very big difference between the annual yield and the daily yield.
It's a very marginal.
Yeah, a very small margin.
Yes.
So they are going to put those two percentages just to show you that the longer you invest, the more you earn.
Okay.
But when you invest for a short period of time, for example, you invest for less than 1 year, they are normally going to use the daily yield, which is now subdivided into small units, daily percentages divided by 365. It means when you leave your money for 1 year, that is annual yield, it will add up to the second interest rate.
Okay.
So there is no much difference. It is just at the timing of your investment.
Right.
Yeah, there is no difference.
So now to that question of between fund manager X, Y, and Z.
Yes.
X has 12, Y has 13, and Z has 14%.
Exactly.
I'm looking at this. I have about 42 fund managers. That means, for someone who's new, someone who's watching us tonight, they're definitely wondering, where do I go? And what decisions do I make? So far you've elaborated which ones, but then 12, 13, 14, which one?
Now, there is a saying that says that when the deal is too good, think twice.
Think twice, yeah.
Right? So actually, you will find a money market fund that is going to give you a return of 25%.
Okay.
But does it mean that you go to that money market fund? So the first thing that you're supposed to do before you join any money market fund is doing the research about that particular money market fund.
Okay.
A money market fund will have 14%, the other one will have 13%, the other one will have 12%. If you do your research well, you'll find the one that has 12%, the low interest, is actually the good one.
Okay.
Now, the difference in the interest rates of money market funds come in depending on the investments undertaken by different fund managers. Fund manager A is undertaking projects that fund manager B is not undertaking, and fund manager C is not undertaking. For example, fund manager A can be investing in treasury bills and bonds. Then fund manager B can be investing in commercial papers or corporate bonds.
Okay.
You find that the investments undertaken by fund manager A has high returns compared to investments undertaken by fund manager B. That's where you're going to see the difference in interest rates. Another thing that brings differences in interest rates is how the money market fund has been invested in by different investors. How the fund manager is going to collect a lot of money and actually be able to pull a lot of resources so that they can be able to invest somewhere else.